It's 2 a.m. in New York, or maybe 7 a.m. in London. You wake up, grab coffee, and immediately check your screen. Right at the London Open, you spot it. The New Zealand dollar is tearing upward in a sharp breakout. The volume is spiking, and the move looks undeniable. You hit buy. Now, look at this chart structure. Moments after you enter, the momentum vanishes. The price plummets, ripping straight through your red stop-loss line before you can even react. This specific price action is known as the Judas swing. It is a false move designed to trick retail traders into following a fake trend. This happens too often to be bad luck. Institutional algorithms engineer these exact market conditions. To survive the London Open, you have to look backward. You need to map out the Asian range, the home session where the daily blueprint is drafted in the quiet hours. Without decoding that early accumulation phase, you are simply providing the liquidity institutions need to execute their trades. Before identifying a trap on a chart, we have to determine the currency's actual destination for the day. The US dollar moves on a complex web of global tech and manufacturing. The New Zealand dollar is tied to a single physical commodity, milk. Dairy makes up a massive portion of New Zealand's exports. Twice a month, global dairy trade auctions provide the raw data that shifts market sentiment. Rising auction prices improve New Zealand's terms of trade, drawing in the foreign capital that drives up the currency. Combine that dairy data with the Reserve Bank of New Zealand. The RBNZ is highly proactive, frequently using a hawkish hold, keeping rates steady while signaling future hikes. That forward guidance triggers the volatility institutions need. Verify Kiwi strength by checking the AUD-NZD crosspair. If the NZD-USD is rising while the AUD-NZD is falling, the strength is coming from Wellington. If both pairs are rising, the move is likely a symptom of broad US dollar weakness. Combining GDT results with central bank policy sets the daily bias. It dictates where the price will eventually go once the trap clears. Domestic liquidity peaks during the Asian session from 2200 to 0600 GMT. In this accumulation phase, algorithms trap price action inside the Asian range. This sideways movement builds up dense pools of buy and sell stops sitting just outside these boundaries. Now look at the vertical line intersecting the chart at 0000 hours Eastern Standard Time. The midnight pivot serves as a reference line for institutional pricing. During the London Open, the manipulation phase begins. Institutions deliberately move the price opposite the fundamental trend. On a bullish day, the price will sweep below the midnight pivot and the Asian low. This triggers the retail sell orders parked underneath. This downward sweep allows institutions to buy at a discount by absorbing those triggered stop losses. Next comes the distribution phase. The price snaps back from the manipulation zone and trends aggressively towards its fundamental target during the New York session. Your execution must be precise. Place your stop loss 5 to 10 pips below that manipulation tail. This specific placement protects your capital against a genuine trend change while avoiding institutional noise. Target your exits at institutional big figures, like 0.6100 or 0.6150. These levels act as psychological magnets where liquidity often dries up. Avoid the dead zone between 2100 and 2200 GMT. Widening spreads and low liquidity make this the worst time for execution. Open your charting software today and backtest the last 20 days. Map the Asian range and observe how many times the London Open swept the low before the real move started. Success in the NZD-USD comes from analyzing the accumulation while the market sleeps, rather than chasing the expansion once it's already underway.